Our next guest says a weaker environment for ad spending could have even bigger implications in the VC world. Let's bring in Joe Marchese, general partner at Human Ventures. Joe, great to have you with us.
Thanks for having me.
I would imagine if you're a private company and you're watching what is happening in the public markets to similar companies and those market caps are just getting halved, that you're girding for the worst. So what are we actually seeing out there in terms of a slowdown in spending, a slowdown in hiring, et cetera?
Yeah, I do think the first slowdown in spending you see in VC-backed companies are ones that were spending for growth rather than spending for profit. I know I hear a lot of people talking about how Google, Facebook, Amazon, and Snapchat are performance advertising companies, but there's different types of performance. There's performance for sales, which drives revenue, and there's performance for clicks or downloads or installs of apps. And that's been, being funded by a lot of VC and growth capital. Ironically, as those things go down, it gets cheaper to buy sales and revenue. So I think you'll see some room on that side.
Yeah. Hey, Joe, what would you say would be like the most immediate knock-on effect? Let's just say the snap is the beginning of a trend for the balance of this year. What are some other areas that you would expect to be weak in this kind of VC-backed tech ecosystem?
Well, so first, I'd caution saying whether Snap is a great indicator for the whole sector. I think that Twitter has very different advertising makeup. It's more brand advertisers, more akin to what you'd see on television during the commercial breaks of a CNBC or on broadcast. Whereas Facebook, Google, Amazon are more direct response marketers, small businesses, SMBs, and those show up in the market first and VC-backed companies. Snap is really interesting because it's kind of in between the two. It has more brand advertisers than Facebook and Google and Amazon, but it has more direct response than television. So I'd caution that. I'd also say that the last time Snap underperformed and then Meta underperformed immediately after them, Snap came right back with a big beat. And I think that their kind of fundamentals are the same. They're focused more on being a utility than a media company. But on the venture side, I would look at things that were focused on buying growth in advertising versus kind of building fundamental businesses that sell products to consumers. I mean, I know we've all seen one of the biggest spenders in the entire market is crypto, and I think you will see a pullback in that spending.
Joe, what happens to the so-called unicorns, the big companies that are private now that were expected to go public in this market environment, and what happens to those valuations?
I think you're going to see a lot wait. I think the ones who are smart and well capitalized that were marking to public valuations will say now's not the time to go public. Not to be marked against that. And you'll see the ones that are strongest will actually outperform because their competition will go away. But they will slow down on the advertising side of things, which then does kind of open up the market. But the thing I'd say for the audience, like coming from my old world, because there's a lot of other public companies in the advertising sector, the big ad agencies, the public media companies. The VC advertising spend is such a small portion. Like what makes up Facebook's advertising spend, so little of it is the Procter & Gamble's, Unilever's, the automotive companies that we know. And I think that's far from a slowdown. The television upfronts are going on right now. And I think that's still showing pretty strong.